Good afternoon, good evening, good morning, wherever you are in the world. Welcome to today's session. Really pleased to be here and finally share some AMM models with everybody. So today we're going to be walking through how to design an automated market maker in Machinations, and we've got a jam-packed agenda today. So I'm going to walk through and do a little bit of an introductions to AMMs and kind of explain how they came into existence and what the kind of the challenge that they're solving. Then I'm going to build a AMM step by step and show you how to build it. Then I'm going to run you through a kind of a fully featured AMM and explain how it's all the different ways in which they can be used and all the different kind of maths and logic that are involved in them. Then I'm going to walk through a much simplified version. I've spent a long time trying to make it as simple as possible, and I think I've kind of got it down to less than 40 objects for a nice simple AMM that you can use in your model straight away. And then we're going to kind of talk about some of the assumptions and error margins and how to mitigate them in our models so that you can be best prepared to handle them. And this is the endpoint we're going to get to today. I'm going to show you this first just because it might look intimidating, but as we kind of walk through the model, you're actually going to find it's very simple. AMMs are one of these very simple things, but they can be quite complicated at the same time. So by the time we finish today, you'll be able to build this model. My name's Matthew. I'm the evangelist for Machinations. Been kicking around the games industry for a while. Please do come and follow me on the Machinations community. I'll post that link into the chat later. And alongside me today, as always, is Cesar, our resident Machinations expert, who will be going through and helping me answer any questions that come up and kind of monitoring chat as we go along through today. And there's also Horia lurking about in the chat as well, keeping an eye on any Q&A that we get. Going to have plenty of time for Q&A today, but please, if you have any questions, it'd be great if you could ask them in the chat or in the Q&A function down the bottom. In fact, I can see some questions that have come in already. All the models that I'm going to show you today will be available on my profile. We're going to publish them as templates later on today, or in fact immediately, maybe even during the session we'll do that. So what is an AMM? And actually, before we even get into what is an AMM, I'm going to talk about stock exchanges and how they work. Quite simple. We have people who are selling stock in a company or some kind of investment. They go to a stock market and they say, this is what I would like to sell my stock at. Somebody else goes along to the same exchange and they say, I would like to buy this stock at this price. The stock exchange matches those orders together and they take a fee for that service. Now, that's been going on since the 18th century. It's a very successful model. It trades very well. Obviously, the biggest ones kind of being London, New York Stock Exchange, Frankfurt, and so on. Now, when it comes to crypto, it then started to be a bit of a problem because there weren't enough people kind of going in offering to buy and sell these things regularly. So it started to cause kind of friction in and kind of people having confidence that if they were to buy into some of these different tokens and different crypto, what impact it would then have if they couldn't then find somebody to buy or sell it. And so this came out, so let's run on-chain decentralized exchanges the way we run prediction markets. And that's a direct quote. So very few people probably know about this. This was when AMMs were pretty much first mentioned anywhere on the internet, which is where this was posted on Reddit and kind of proposed this whole idea. And I'll post this link to the chat at some point during today's session so you can have a look at it. My favorite comment in there is that, this rather obscure Reddit post basically created a multi-billion-dollar marketplace. And this is really the kind of the key part that we're going to be walking through today, which is this formula: A times B equals K, and the kind of variations of this and the kind of the core principles of an AMM. So let's get into it and let's build an AMM in Machinations. So we've got a nice blank canvas and we're going to kick off and build an AMM. So the first step of an AMM is obviously liquidity. and the kind of, this typically is often in the form of two pools, one of them being the token that we're going to have inside our game, the other one being the cryptocurrency that we're going to be connecting to. So the one on my left here, I'm going to call this my token, and the one on the right, I'm going to call this crypto, because the most common use case that we certainly see are when we're looking to understand a game economy. So we've got some kind of token that's inside the game, and this is going to be exchanged out of the game economy to some kind of cryptocurrency. And we'll talk about those in more detail as we go. This session, someone's just asked how long this session is going to be. We've got scheduled for an hour. We'll see how we get on. I think I'll probably talk for about 35 minutes, and then you'll get bored of me. So one of the things I find really helpful in Machinations is that you can put words into these state connections rather than having the letters. And I find this really helpful in order to kind of keep track of our formulas. Now I'm going to keep this fairly generic, so I'm going to put in 50,000 tokens into my liquidity on both sides to start off with. Then this is my formula. So for this, I'm going to do token times crypto, and this is going to be my K number. So that starting point, if I hit step, this is going to take 50,000 tokens, 50,000 crypto, multiply those together to give me a K number of 2.5 billion in total. Now I'm going to remove these at the moment. Now, there's kind of a couple of different ways that we can then interact with our liquidity pools. Both of them are going to involve either putting in tokens and taking out crypto, or putting in crypto and taking out tokens, the normal kind of trade. Now, for the most part, we're going to be not too worried about the crypto and how many tokens we've got going around in circulation of crypto. For the most part, they're external to our game economy, so we're not going to worry about them. So in this case, I'm going to be just using a source and a drain to track how many are kind of entry and exit of crypto from our AMM. But for our token, I'm then going to use another pool. I'm going to call this tokens in game. And these are going to come in to the top here. To try and keep it neat, I'm going to route these round so that they look like they're coming in. And then as we take them out of the AMM, I'm going to route them back around so they go back out to here. Now, obviously, if we're building a full game economy, we might have a whole bunch of metrics that are going to determine how many tokens are going to be bought and sold each step. But just to keep this really simple, I'm going to do a little random number generator. So I'm just going to have a source, a pool, and a drain. I'm going to make both the source and the drain automatic. I'm going to make a label on there all, so it'll remove all of the resources in there. Then I'm going to put in a D1000. So that will give me a number between 1 and 1,000 each step. So if I hit play on this now, this random number generator is just going to tick over, and it's going to flash up a different random number each step. So I'm just using that to kind of create me some data of how many tokens are we going to be selling into our AMM each step. So we've determined how many we're going to be selling into the AMM. So I'm going to create myself a little register. I could take this directly from the pool, but I'm going to explain why I'm doing this in a separate register for a moment. And I'm going to call this T sold. So number of tokens that I'm selling each step. And in here, I'm going to call that T sold as well in my formula. So now I've got whatever numbers coming up in here is going to come up in my register. And now I'm going to pop this as an override. so that if I make this automatic and hit play, however many tokens I'm getting here will then be pulled over from my tokens in the game. So I better put some tokens there for now. We'll just stick a 5 million tokens, I'll do. So now each step, whatever number I'm randomly generating will be taken into my token pool. Now, if putting tokens in, we're going to have to take tokens, crypto out to rebalance our AMM. And the really important fact of an AMM is this number that we have here, which is our 2.5 billion. We want this number to stay the same all the time. That's our constant, regardless of how we trade or how many tokens we put in, how many tokens we take out. That number's always got to stay the same. So in order to work out how many crypto we then need to take out of our AMM based on the number of tokens that we're putting in, we need to do some maths. Now, the part that probably took me the longest to get my head around when I was trying to understand AMMs for the very first time, and I was kind of trying to understand them, is that in most ways, when you buy or sell something, the price is calculated at the start of that transaction. Whereas with the AMM, the way I think about it is really whenever you're doing a trade with the AMM, you're calculating the price as if it was the end of that transaction. And let me explain that in a little bit more detail. So if we take the number of tokens that we have inside the AMM, so I'm going to label that state connection token, and then we take the number of tokens that we're going to be adding in. So in this case, that's my T sold label. And in here, I'm then going to put my token plus T sold. If I hit step on this for a moment, this is now going to show me that, okay, if we're going to add 521 tokens in the next step, that means that in total in our token pool, there'll be 50,521 tokens there. Now, that's going to upset the number of what the K number is. Therefore, I need to rebalance my K number based off of this number. So the way I can then calculate this is to take my K factor, and I'll root this, trying to keep it neat. So I'm going to label that K. So in my formula box here for this register, I'm now going to do K divided by token plus token sold. So now what this is calculating, it's saying that, well, we know that the K is token multiplied by crypto. Therefore, if we add 521 tokens to this pool in the next step, we need to adjust the number of tokens in our crypto pool to 49,484. So that's the bit I think is the most confusing. And once I finish this off, we'll go through it a couple of times just to make sure that logic is making sense. So this now gives us a new balance. So I'm going to call this new crypto balance in this register. And then I'm going to add another register over here. And from here, I'm going to run a state connection. I'm going to call this state connection new crypto. And we also, if this is giving us the number of crypto that it should be, we also need to know, well, how many crypto are in that pool at the moment. Therefore, we're going to grab another state connection from our crypto pool. And I'm going to call this one crypto. And in here, I then want to calculate in this register how many resources we're going to take out and send to our drain. So the first thing I'm going to do is mark that as 0, add myself another state connection into here with that override as an equals. And in my formula box, I'm then going to say, Okay, well, I need to know the difference between those two numbers. Therefore, my formula is crypto minus new crypto. So this is then generated for me 515. Now that we've got that set up, I'm going to make my drain automatic for a moment. And we should be now ready to see that trade happen. So what's going to happen is we're going to put in 521 tokens. And in order to rebalance our K number, we're going to remove 515 crypto. There we go. That transaction's now taken place. Our 2 token pools and our liquidity have been adjusted, and our K factor is still exactly the same number. The next transaction is 657. So I'm taking my T sold number, my token sold number of 657. And that's how many resources we're going to input into the token pool. In our new crypto balance, it means that our tokens plus tokens sold, and then we're dividing that K number of 2.5 billion by those two added up together. This gives us a new balance that we need to have in crypto pool of 48,848. And over here, when we look at the difference between what's in our crypto pool right now and how many tokens it should be, that difference is 635. Therefore, in the next step, that's how many resources we're going to take out. Are you following me, Cesar? Is this making sense to you?
It is making sense to me, yeah.
Perfect.
I'm not sure if everyone is following, but it's a pretty mathematical thing in the end, right? It's not very, I don't know, it's maybe hard to grasp the concept of like decreasing one amount, increase one amount and take from the other, but first calculate that amount before you decrease it. There's some order of operations in there that may cause some confusion, but other than that, I think it's not very complicated. So
yeah, I mean, certainly when I first went through this and kind of had to understand this formula, I think is the hardest one. But really, when you break it down in terms of, we're always going to keep that K number the same. And in order to do that, we're going to work out, okay, this is what our balance is at the moment. This is what the balance is going to be once we've added these extra tokens into it. So if we take K divided by those two numbers, that's going to give us our new balance. And this register here is just going to work out the difference between those two. And that's how much we're going to drain. So if I hit play on this now, it's going to carry on going. We're going to constantly do transactions where we're picking a number and we're randomly picking a number of tokens. And that's how many it's going to remove the corresponding amount of crypto tokens as needed. Now, as this goes on, obviously we're only doing one-sided transactions at the moment. This means that as we go further through this run, the number of crypto tokens that we remove in relation to the number of tokens that we're putting in is constantly dropping, because we're making this number smaller. And this is where we start to get the kind of the bonding curve, and that price sustainability inside the AMMs. The more scarce one side of the AMM it is, effectively the more valuable it is. So now we've done 60 odd steps. I'll pause it there for a moment, and then we'll have a look at what's happened with those ratios. Now, I started off this simulation where both the token pool and the crypto pool were equal. This means that one token was worth one crypto. Now that we've got a big difference between the two. So with 699 resources going in the next step, the number of crypto that are coming out of the AMM is now a significantly smaller than 1-to-1. So it's now 260 that are coming out. And if I let this carry on playing, that ratio is going to continue to change. and to the point where we have to put more and more tokens in to get the diminishing number of crypto back out of the AMM. Is that making sense so far? So the next thing we want to do with our AMM, and once we've kind of understood this core logic, the important thing we want to know is what are tokens going to be worth? And for this, we then need to understand, well, what's our crypto worth? So first up, let's just set a value for what each crypto token or coin is worth. So for this, I'm going to do this in cents, and we're going to do a US dollar tied coin. So let's do USDT. And I'm then going to have a register, and this register is going to look at, well, what's my price? So I'm going to set this as price. I'm going to set, I'm going to need to know how many crypto tokens we have in there. So again, I'm going to put another state connection with crypto on it. It might sound like a bit of extra work going through and labeling these state connections each time, but I really find it makes life much easier in the long run when you're going back looking at a model and you're trying to remember where these state connections come from. So I just find it just makes my life easier. Now, the value of each token is going to be with a formula of what's the price of each token, of each crypto, sorry. So price multiplied by crypto, pop some brackets around it, and then that's going to be divided by token. So what this is now going to do, this formula, is going to look at, okay, the value of the tokens is worth whatever the value of the crypto is in total. So if we then take the number of tokens that we have in our liquidity pool and we do this calculation, it's then going to calculate for us exactly how much these tokens are worth. Because they're both starting off with equal liquidity, so 50,000 tokens, 50,000 crypto, the price of each crypto is 100 cents or $1. Therefore, the price of each token is going to be 100. Now, as I leave this running, I'll zoom in a bit so we can see the number. Because we're constantly selling tokens into the AMM and we're removing crypto, we're going to see the price of our tokens going down all the time. And I can do this with a huge number of decimal points. If I wanted to, we could then add a rounding or a fix or adjust how many decimal points we were seeing. But for now, let's just add that into the chart and enable us to track the price inside the chart of our token. And I'll speed up this model so we can start to build up some data a little bit faster. So this is going to show our token price constantly falling. Importantly, regardless of what we're doing in any of our transactions, if I were to pause my simulation at any point, we're then going to go back to a number close to 2.5 billion. And wily-eyed folks amongst you will notice there's a bit of a difference, and I'm going to explain that in a moment. But our chart's going to show this nice curve, and this is where we're getting that bonding curve. In fact, let me do this another way. I'm going to set a constant number. So I'm going to make these two passive for a moment, and I'm going to put 1,000 resources into here. Clear my chart first, hit play. So now we've got a constant number of tokens that are being sold. The amount of crypto that's withdrawn each time is slightly less. So this should start to create for us a lovely curve where, because we've got a constant number of tokens coming in, it's showing that that bonding curve in the relationship between the two pools. So hopefully now we've seen kind of one side of the AMM. I'm going to switch over to something slightly more complicated. Let me turn off some of these layers for a moment. Just to get us to the same starting point. So here we are, here's our starting point. Same sort of configuration. We've got our token, we've got our crypto, we've got the same elements to it. Oh, let me add that one. So this is the side that we started off with. What I've now done to this is I've added another element that you might want to think about with your AMMs, which is the fees for staking rewards. So every time a transaction goes through an AMM, there's some fees that are taken. These fees are then allocated to both the owner of the AMM and also to the actual people that have staked their tokens or their crypto into the AMM. And so if I would hit play for a moment, we'll let some transactions go through. But here I'm then keeping track of how much we're actually collecting from the AMM in token rewards. And this is done by adding in this extra gate. This gate is then splitting all the resources that go through this by 99.7% and then capturing 0.3% in transaction fees. Now, Cesar, you might want to just back me up on this as I try and explain how deterministic gates are working with these sorts of numbers and how it maintains that correct balance between those. Because obviously that's quite a small percentage, 0.3%, and it can mean that individual transactions, there'll be a rounding error in here, which causes a slight variation of how much is collected in transaction fees. Do you want to just explain how deterministic gates work and how it'll make sure that it maintains that balance?
Yeah, sure. So deterministic gates have the property of always trying to balance out the resources that they send out to try and adjust to the ratios of the outputs, right? In this case, we have two outputs, 99.7 and 0.3%. If we had 1 billion resources coming in, let's say, there will be no problem because the two outputs would be able to split the resources according to that. If we had, say, 100 resources come in here, then one output would need to split 99.7 resources and the other one 0.3. And that's not possible because resources are integers in Machinations. What would happen in this case is that the deterministic gate would try to balance that over multiple steps. So let's say in the first step, we would put 100 resources through the gate. What would happen is that all 100 resources would go towards the drain on the top and 0 resources towards transaction fee. The deterministic gate, however, remembers that it sent those resources in these proportions, right, 100 to 0, and during the next step, we'll try to balance out that amount. Now, 0.3% roughly means a third of a resource, let's say that. So what the deterministic gate will do is, over the course of 3 steps, it will send a single resource towards the transaction fee resource connection and all of the other towards the drain at the top. Obviously, it's not going to be every 3 steps every time because it's still less than a third. So over time, it will amount to a bit less than that. But as a general rule, that's how deterministic gates work. So even if we're talking small resources, over a large number of steps, they should get to those ratios that are specified on the outputs. But if we're talking a low number of steps and a low number of resources, then you might see some differences like Matthew described that may split the resources in an uneven way, let's say.
Perfect. Thank you very much, Cesar. Now, we walked through the construction of this side a moment ago. One of the things that the added kind of logic that we're added in for this is obviously the amount of tokens that are now coming in being modified. So we're taking out that 0.3%. So in our registers here, we've taken that into account. So we're multiplying the number of resources in our T-sold register by that 0.997 to add in that extra 0.3%, so that the amount of tokens that come into here are then correct, and we're not losing any kind of detail or just losing out 0.3% overall, and we're keeping our constant in the right way. The other side of this AMM is we've looked at setting tokens into the liquidity pools. The other way that we want to do this is to look at how many tokens that we can buy from the liquidity pool and how much crypto we have to put in for this side of it. In order to do this, I've got some random data sources. So these are just as we saw before, I've created these random number generators to generate me some numbers. So for this side, I've got a random number generator that's saying how many tokens are we buying each step. Let me do one step and we'll leave it there. So here, in the next time that this is going to be used, we're going to take 237,000 tokens, and that's how many we're going to buy from the AMM. This goes into my tokens bought, and in order to counteract that transaction fee, because my game actually requires the full 237,000, I need to counteract that tax that's being taken by the AMM. So therefore, I'm dividing it by 0.997 to increase that number. So it's going from 237,000 to 238,000. So that as that number of resources come out, 0.3% is going to go off in our transaction fees, and the rest will come out. Let me add that layer back in. So then my 99.7% is going to carry on back into my game economy. Then, just as we saw before, we're using that K number. So here I'm taking my K number and I'm dividing it by the number of tokens that are already inside our liquidity pool. So this is coming from my 10 million tokens I have here. And then I'm subtracting from that the number of tokens that are being bought in the next step. So my T bought number. So again, this calculation, token minus token bought, that's going to show us how many tokens should be in that liquidity pool after the transaction. So then we're taking K, we're dividing by that number to find our new crypto number. And our new crypto number, I'm then bringing over to here through this state connection. And I'm saying, okay, I'm going to take my new crypto number and I'm going to subtract from this the existing crypto number. So I'm taking how many crypto do we have in our pool? And I'm taking our new crypto number minus what we have in there at the moment. This is giving us a balance, in this case, 2.5 billion. And I'll explain why that's such a big number in a moment. And what I'm then doing is I'm then obviously dividing that number by 0.997 to again counteract my transaction fee. And setting this in with a override back into my resource connection, and that's how many resources we're going to push into our liquidity pool. So it's exactly the same as the first kind of step-by-step process we looked at on the top of our liquidity pools here in terms of selling tokens into the liquidity pool, but we've just done some kind of reversing of that mathematics to look at it from the other perspective of when we're buying tokens from our liquidity pool. So now if I hit play, every couple of steps here, we've got different transactions going on. So we've got tokens being sold to the AMM, tokens being bought from the AMM, going back around the other way, and tracking how many token rewards we have each step. Now, there's two other types of transactions that can happen with an AMM, and it's kind of really up to you whether or not this is something that you want to factor into your models. depending on what your objectives are that we'll talk about in a moment. And this is adding liquidity into our tokens. Now, if we go back to our this post from the original launch of, or the kind of concept of AMMs, there's this line here: in the version where people can invest, K can change, but only during an investment withdrawal transactions, not trades. So we've shown how the K number isn't being adjusted during trades. But what we now want to look at is, okay, well, if we invest more resources into our AMM, obviously the K number can then change. So what I've created here in this section is a way for us to be able to visualize and understand how that's happening in the AMM. So I've got a source here that's adding liquidity, and another random number generator that's going to generate me a number. So I'll hit a step. And what we're now doing is we're looking at the difference between, or the percentage of each of these of the liquidity pools. So I've got 10 million tokens against 100 billion crypto. So obviously that crypto number is significantly higher. And in this case, this means that if we were to add 482,000 into the total liquidity, if I look at this formula, I'm doing token divided by token plus crypto. So I'm looking at the total number added up between number of tokens and the number of crypto, and then I'm dividing the number of tokens by that number to give me the percentage of tokens to total, and then I'm multiplying that by how much liquidity we're adding in that step. So this means that for us to add 48 tokens and 482,000 crypto. So if I hit play, I've got an automation layer on this model as well. So just to explain what that's doing, I've got a automatic gate here, and this has got some percentages which are then triggering these different actions each step. So I've got a 35% chance, and let me show you where this is going. This is going over to here to trigger a sale to the AMM. I've got a 35% chance of this triggering a purchase from the AMM, and I've got a 15% chance of it triggering a adding liquidity event. So there's one's just happened now, and this is adding liquidity to our pools. Because it's keeping exactly the same ratio, our T number is increasing, but when we're adding liquidity, the price of our token or the price of our crypto isn't changing at all. So if I look at the same formula we had before, here I've got crypto, and I've got an extra bit of maths in there that I'm going to explain in a moment. This is then going to be calculating our price. Whenever we adjust the amount of liquidity we have in our pools, this price isn't going to change. Then in exactly the same way, we then have a removing liquidity event. So this is a drain now rather than a source with a 15% chance. And what this is going to do, it's going to remove liquidity in the same ratios. So just as we saw with adding liquidity, whenever we remove liquidity, we do that in exactly the same ratios that are already in place. And this means that we're not changing the price whenever we add or remove liquidity. Does that make sense to you, Cesar, that liquidity part?
To me, it does. Again, yeah, I'm probably not the best person to ask this.
That's true. But please do, if you have any questions. I know I can see there's some questions kind of going through. I think there's at least one question in the Q&A. I'm going to try and grab it in just a moment. It's a big question, so it's going to take me a second to read it. But hopefully this is making sense. Overall then, here, hopefully now we've been through every element of this, but this is fairly complex and it might be slightly overkill for your requirements. And if you want something quick and fast, that's what we've got for you today. So also going to be sharing this model with you today, which is our super cut down version of the same thing. Now, I've got an automation layer here that's triggering a purchase or a sale each step. So I'm going to hide that for a moment and just try and focus on the core areas that we have here in this cut down AMM. So we have our token, we have our crypto. What I've done here is, rather than having two registers that are then used, in fact, I think we had 3 registers in our full one used to do this calculation. Here, we're doing all of this inside one step. So here we're doing crypto, and then rather than crypto minus the new crypto balance, what we're doing is we're taking that formula from the previous one and adding all of them into here. So now we're taking those tokens and tokens sold, adding those together, dividing the K number by that number to give us the new balance, and then doing crypto minus that part of the formula to give us the new balance. So if I just hit step, here we're adding 171 tokens being sold into the AMM. We're going through that calculation, and it's equaling 170 that are going to be removed in the next step. And back on the other side of here, we've got the same thing again, but all condensed into one neat little register. So it's doing that same type of calculation, but this time just the other way around, to look at it from the reverse perspective of buying tokens from the AMM. Now, this is actually the perfect example, and one of the key kind of things we want to think about when we're looking at an AMM to understand where we could start to have issues. Machinations works in whole integers. So these resources that are moving around, they're always whole units. There's no fractions or decimal places on these transactions. So as I hit play and I let this play out for a little while, we're triggering both purchases and sales into our AMM. If I pause this at any moment, it's going to be the same number. Oh, it's going to be exactly the same number. Thank you, Machinations, Monte Carlo. But what we'll start to see is, because there's a rounding error, and I'm using the round function in these registers to round this up to a whole integer, this means that we're then we'll start to get a margin of error on our AMM over multiple steps and over multiple transactions. This means that we can then, we might start to cause a problem. In this example, so this will be quite interesting for you crypto folks. So I set the price of this yesterday, maybe, of where Ethereum was. It's going to depress me too much to look at what the new price of Ethereum is. So we'll just pretend it's yesterday and keep $1,590 for an Ethereum. I'm doing this in cents, so I've actually got 159,000 cents to help calculate my token price. Now, because we've got an equal number of crypto and an equal number of tokens in here, this means that at the start of my simulation, each token is going to be worth 1 Ethereum, which means that each token yesterday was worth 159,000 cents, or $1,500. Now, we might have a liquidity pool that big, but what's probably slightly more likely is, rather than having 50,000 Ethereum in there, we might have slightly less. So maybe we'll have 10 Ethereum in there. Now, I'm sure it's not going to take anyone very long to work out. This is going to cause us a very, very serious rounding error issue. So because of that rounding error and the way in which Machinations works with whole integers, we've got all these transactions going on, but the number of crypto resources that now need to be added or removed from the liquidity pool each step is going to be rounding down to 0 every time. Our token price is never going to change. Our constant is going to get more and more incorrect because we're adding and removing tokens, but that rounding error means we're never changing the number of crypto that we've got in our pool. So the way in which you can approach this is, rather than trying to do anything funky with this, I take the number of resources that I have in my crypto pool, and say we had 10 Ethereum in our liquidity pool. What I'm then going to do is I'm going to add 9 zeros onto that number. So effectively multiply it by 1 billion. So 1, 2, 3, 4, 5, 6, 7, 8, 9. So we've now got 10 billion Ethereum, which is really 10 Ethereum, but multiplied by that number. And this is where I'm going to take my crypto number and I'm going to divide it by the same amount. So now when I hit step, my balance, the price per token isn't changing, but this means that I can now eliminate a huge portion of that rounding error that I'm getting each step. And it's not going to be causing such a big drift or a big inaccuracy anymore. Hopefully that's makes sense. And in the full model I showed you a moment ago, I've already got that set up, which is why I've got a really big number in my crypto pool, and that same calculation done when I'm looking at the price and the value of my token. I'm just going to read some of these questions for a moment. Cesar, you've got an interesting approach when we look at doing both a purchase and a sale transaction in the AMM in the same step. Do you want to talk about that while I read some of the questions?
Yeah, it's not really that. I'm going to talk about it in theory. The idea here is that when selling and purchasing happens in the same step, let's say we are looking at the total sold and bought across an entire day. You can sum it up to, let's say, 50,000 was bought and 100,000 was sold. That would amount to 50,000 was sold in the end, right? So what I'm doing is I'm basically making the difference between the two and taking the result and using that. In reality, for one single player, it will be important. It's important whether the purchasing happened first it's important at what state the AMM is at that particular moment for a single player, because it will dictate the prices at the moment of the purchase. But for the AMM as a whole, and for the price of the token going into the next day, it becomes irrelevant for the larger ecosystem. So that's my approach for a larger ecosystem. I do not recommend it for a single player. For a single player, probably it's best to handle individual transactions.
Perfect. Thank you very much. A couple of great questions.
There's a very long one. I saw it. I don't know when you want to tackle it.
This is perfect because it's one of those really important ones that I did want to talk about today. So thank you, Alex, for asking this question. So the question is there a way to model different market behaviors of multiple AMMs? For example, if an in-game token pair is available in 2 different AMMs, how do you account for the different behavior from player personas on different AMMs? Brilliant question. So there's a few ways that we can kind of think about that type of approach of having, especially if it's a popular token or if it's a popular game or whatever it is, there are bound to be multiple AMMs around impacting, and each one might have its own price. It's going to have its own liquidity pools, everything else. We could go down the route, depending on what we're looking to simulate and what we're looking to test inside Machinations. We could go down the route of creating multiples and tracking each of these different systems inside Machinations. In reality, what we tend to see is if there are multiple AMMs and there's a big or any kind of price disparity between the two, through arbitrage, there's going to be people out there that will be looking for these opportunities, spotting those differences in the values of the tokens, and will be making trades between those multiple AMMs, and effectively that balances out multiple AMMs. So quite often when we're thinking about this from a game economy perspective, and we're looking to do some testing to understand how the game economy operates and what that's going to potentially do to the token values, that because of that arbitrage opportunity that gets created between multiple AMMs, and the fact that there'll be some trading that goes on that kind of balances them out, it's a self-correcting system where it's the added value of trying to build a model with multiple AMMs and then building some logic so that if there is a disparity between them, that arbitrage takes place. It's not necessarily going to give you any value to what you're actually trying to model and actually trying to test. Therefore, normally in the majority of the models we're building when we're evaluating an economy, we'll do just one AMM and use that as a kind of indicator of the kind of the token values. Hopefully that makes sense. Great question. Thanks for asking that. How a whale coming in out could you use the model to explain how a whale coming in and out might impact the AMM? That's a great question. So I think really what the question is there, and it is a whale kind of having a huge impact on it could obviously make a difference. The other one is a lot of teams that are certainly building games, they'll go out for external investment, and those investors are often buying the token, which is then going to be part of their investment. They'll often have some kind of lock-in period or vesting period that they can't sell those tokens until they've vested. So we'll quite often look at a game economy and look at, well, what happens if those investors that have those tokens dump those tokens the moment they get released to them? What impact does that have? So in the Machinations model, what we might be looking at is building a bit of extra logic in here to look at, okay, here's the how many tokens are held. So I'm going to say that there's 50,000 resources here in this pool, and I'm going to create a little countdown. No, I'm going to do it the other way. I'm going to create a countdown with a drain. So I'm going to say, right, 10 days in, this is going to be set to push, and it's going to be automatic, and it's going to trigger when this pool is less than 1. So once this pool is empty, it's going to condition this pool. It's going to send these resources into my token sold. So now I'm going to make this so that we're doing both purchase and sales each day. So now if we track our token value at step 10, if I clear my chart for a moment, we can got our transactions going on of around about 1,000 a day. Or if I make that automatic, it would help. So now inside our logic here, at day 10, we're going to sell an extra 50,000 tokens, and we can then hopefully we'll be able to spot this in our chart. Oh, but I didn't write all on there. Come on. I'll try that again. Take 2. Edit that bit out. We'll let that tick over, get down to 10 again. We're going to put an extra 50,000 in our sold tokens. There they go. Great big transaction went through. So then we can check out our chart and see what that did to our token values. So that's a great way of kind of explaining or testing out how those sorts of events could impact our token values. Hopefully that answers your question. Excellent. I think we're just about at time, I think. So this has been fantastic. I'd love to know if anybody has any other questions, please do drop them in. I'm going to hang around to answer this last question we have. Could I give a quick overview of the basics of what operations represent from the perspective of a user, player, investor, selling tokens and liquidity, buy crypto, etc. So I'm going to use this model, I think, as a good example to kind of do that. First, I'm going to take out those parts. So I think the key kind of use case, or the way in which I often think about these models and how to actually use them in anger, if you like, within any kind of simulation that you're doing, is often the key part that I'm looking to simulate is what's going to happen with our token values, and using an AMM to understand this relationship between how much the token's going to be worth based against its trading pair. And here I've got a random number generator, which is saying how many tokens are being bought and sold each step. Now, here I've got this, I'm just doing it with random numbers. In reality, this is going to have some kind of logic around it, which is going to represent the actions that are going on inside the economy, inside the game. I often think of this as kind of being this side of the AMM is what's going on inside the game. The right-hand side of this is what's going on outside in the world that's impacting our crypto values. Now, those crypto values aren't something that we're probably able to influence from our game economy. So once we've built out the logic that's looking at how players progress, how players interact, how many tokens the players are receiving as potential rewards, how many tokens the players are buying as kind of drains inside the economy, or something that is beneficial to the player to give them a motivation to kind of using those tokens. What we then want to do is we want to then look at the total number of tokens that are being bought and sold each step, and using that. So rather than having a random number, there's going to be some logic behind how many tokens are being bought and sold, and using that to drive our AMM model to be able to understand, well, if we did have 10,000 players in the game and we had 20% of them that were producing a certain number of tokens, 80% of them were consuming another amount of tokens, what's that balance, and what's that going to do to our total supply and demand that's going to impact our AMM? So hopefully that answers that question. And I must actually just give a shout out to some great people that kind of helping me kind of build out these models. Dion, I don't know if you're watching this or if you're in today's session, he's been a great guinea pig for me, helping me practice today's session and going through and talking all sorts of theory around AMM modeling and statistics. Please do, if you're let me share this. So in a moment, I'll be sharing all of these models to my community page, which I think Hori has already kind of posted into the chat, but do come along, follow me. Mostly I'd like you to follow me just so I can try and have more followers than Cesar, just out of pure ego. Also, please do come along and chat to us in our Discord or in our on any of our kind of social channels. Love answering questions. If you have any questions or any feedback on the models today or how we've built out these models, I've seen a number of different AMM models in the community. I'm not saying mine is the best, but mine I think is the one I understand the most, which is why I presented it today. So if anybody else has any suggestions of how you've approached modeling AMMs, we'd love to see them. So please do come and chat with us on Discord. Have I remembered everything, Cesar? Is there anything I've forgotten? I always feel like there's something I've forgotten at the end of these.
No, nothing, except for the fact that you told people you want to have more followers than me, and I have a private account, so I have 0 followers. So you're already winning on that. That's great. And I will say it, Matthew, that your AMM is the best one out of all of them.
You think? I've seen some beautiful ones.
I will say it here and now. Maybe not the most pleasantly looking, but the best functional one.
Nice. Good. Excellent. Well, thank you very much, everybody. Please do enjoy the rest of your day. We'll see you in the social channels. See you on Discord. and enjoy the rest of your day. I'm going to post these to my my channel right now so that you can all have access to them. Thank you very much. Bye.